When a government takes on debt, is it actually building a stronger economy for the future? Or is it just a temporary sugar rush, a short-term fix? It's one of the biggest debates in economics. So today, we're going to dive deep into this, using a really fascinating new paper from the Arab Monetary Fund that gives us a whole new way to look at the problem.
Okay, so the paper is titled Public Debt and Economic Growth in Arab Countries, Structural or Short-Term Benefits, and it's by Omar Chafik, Abdalla Sirag, and Anwar Othman. Let's just start with their own words right from the abstract.
So their summary gets right to the heart of it. They're basically arguing that a lot of previous studies kind of missed the point because they didn't separate the short-term and long-term effects of debt. Their analysis, which looks at 21 Arab countries, finds that public debt can help long-term growth, but it has almost no impact in the short term. Let's dig into exactly how they got there.
So here's our game plan for this explainer. First, we'll look at the central puzzle itself. Then we'll unpack the paper's really unique method. After that, we're going to hit the findings on both the short-term and the long-term impacts. And finally, we'll talk about what this all means for policy.
First off, why is this so hard to figure out in the first place? I mean, the economic literature is just jammed with studies that completely contradict each other. There's really no consensus on whether public debt is a good thing or a bad thing for growth. This paper suggests the reason we're all so confused is that we've been asking the wrong question all along.
Now, this is where it gets really interesting. They point to this core tension. See, a government can borrow money for two totally different reasons. On one hand, it can fund big, structural investments. Think infrastructure, education, healthcare, stuff that builds capacity for the long haul. Or it can borrow to just goose consumption during a downturn, a short-term stimulus. The effects of those two things on GDP are worlds apart, and if you just lump them all together, you're going to get a really murky picture. And that leads us to the paper's key innovation, its secret sauce, if you will. To solve this puzzle, the researchers decided to stop looking at total GDP. Instead, they split it into its two fundamental parts. Think of this as their special toolkit that lets them look at the long-term structural effects and the short-term demand-driven effects completely separately.
So the first component they look at is potential output. Now, this isn't the actual GDP you read about every quarter. It's a measure of an economy's maximum sustainable production capacity. It's the structural foundation, the supply side, that really dictates how much an economy can grow over many years.
The second piece is the output gap. This is simply the difference between the actual GDP and that potential output we just talked about. It's all about short-term swings. So a positive gap means the economy is running hot, maybe too hot, while a negative gap means there's slack. You've got unemployment, idle factories. This is all about the short-run demand side of the economy.
So, and this is the crucial part, they built two totally separate econometric models. One model looks at how public debt hits the output gap, that's the short-term story, and the other model tests how that same debt affects potential output, the long-term structural story. By splitting these two things apart, they can finally get a clear signal instead of all the noise.
And believe me, their analysis is solid. They used a panel dataset covering 21 Arab countries for over 3 decades, from 1990 all the way to 2021. The debt data is from the IMF, other key variables are from the World Bank, and for the methodology, they're using a technique called panel-corrected standard errors with fixed effects. All you really need to know is that this is a robust way to control for all the unique, unchanging characteristics of each country, so they can be confident they're really isolating the true effect of debt itself.
Okay, let's get to the results. First up, the short term. Does taking on more debt actually kickstart the economy when it's in a slump? Does it help close that negative output gap?
The answer is, not really. In fact, it's pretty stunning. The model found a statistically significant but incredibly weak negative relationship. A 1 percentage point increase in the debt-to-GDP ratio is linked to a tiny 0.01% decline in the output gap. So what does that mean in the real world?
Well, the takeaway here is pretty stark. For the Arab region, at least during this period, using public debt as a short-term stimulus tool seems to be almost completely useless. The impact is so close to zero, it's basically a rounding error from a policy perspective.
All right, so if debt is not a short-term fix, what about the long game? Does it help build a stronger, more productive economy? Does it improve that fundamental potential output? Honestly, this is the much more important question.
And here, the story gets a whole lot more interesting. It turns out the answer's not the same for everyone. When they broke the countries down by income level, the analysis showed a clear, positive, and significant effect for both high-income and middle-income Arab countries. For these groups, an increase in public debt actually does lead to better long-term potential growth.
But, and this is a huge but, here's the critical split. For the low-income countries in the region, the model found no statistically significant relationship whatsoever. Let me say that again. There is no evidence that public debt helps these economies grow, not in the short term and not in the long term. That is a massive finding.
So, of course, this begs a question. Why? Why does debt seem to work for some countries, but not for others? Let's dig into the paper's explanation and what it all means.
A big part of the answer seems to be this thing called the crowding out effect. This table is super revealing. It shows the impact of public debt on total investment. For high-income countries, public debt seems to actually encourage or crowd in private investment. But for middle and low-income nations, it's the exact opposite. Government borrowing seems to displace or crowd out investment from the private sector. The thinking is that in these economies, there's a smaller pool of savings to go around, so the government and private companies are basically fighting over the same pot of capital.
So the big takeaway is that just borrowing money isn't enough. It's not a magic bullet. The paper's #1 recommendation is the need for way better strategic planning and management of public debt. It's about making sure that borrowed money is funneled directly into productive long-term investments that actually boost the economy's capacity, not just used to pay for current spending.
And this really leaves us with the final critical question. This study shows that debt is just a tool. And like any tool, you can use it well or you can use it poorly. So if it's managed strategically with a clear-eyed plan to boost productive capacity and work with the private sector, can it finally become an engine for sustainable growth for all economies in the region, not just the ones that are already well off?